Good day, everyone. I'm Sam Raposo, admin for the Option Wheel Strategy Facebook group. And together I have Gianmarco from Option Trading Club for our weekly review. Gianmarco, welcome.
Hey Sam, how are you?
Very good. Let's review, Gianmarco, some of the action that we had this week. Pretty positive week overall.
Yeah,
That was great. So I think a
yeah,
lot of
yeah,
people are happy.
yeah,
So let's take a look
yeah,
at
yeah,
the indexes that you have for us today.
yeah, absolutely. Very, very interesting end of the week, I would say. Okay. Okay, can you see my screen?
Not yet.
No?
Yes, here we go. Well, now I could see your screen.
Okay, perfect. Okay, let's start with the broad market, the S&P, and wow, what a week.
Yes.
We were here last Friday, and a lot of indecision in the first 3 days of the week, and then look at here. Not so much the gap on Thursday and the continuation, this solid green candle. I mean, barely no shadow. And but what is more impressive is what happened today. Another gap up, and of course not so much of a continuation because it was almost unsustainable. And so what's going to happen next? What do you what do you say?
I don't know.
Is going to
I'm afraid
continue?
of that resistance of that resistance
Yeah.
when we go back, but we'll see. I guess next week.
I mean, everything is possible. If I have to forecast something, I would say that probably we are a little extended on the upside now. And so I think we have to expect some sort of at least consolidation coming into the next week and maybe a pullback. Because I mean, after 2 days like this, I don't think the market can sustain this run more. But I mean, anyway, everything is positive so far. All these tests of the supports down below that we saw in the previous week has hold very well. So overall positive. Just need to be careful in the short term because we may have some volatility and some up and down. And this has been today and the last 2 days the same. Also very similar in the Q and also in the Dow. Look at the Dow, how strong this has been. The only difference here is in the small caps. And you know, sometimes the small caps, the IWM, here the ETF, get out of sync in comparison to the rest of the market. So this could work like a leading indicator. Sometimes I use this as a leading indicator. And you see what happened today. The gap yesterday, not so much of a continuation. If you compare this green candle here to the one in the SPY, you can see a big difference. So during the day, there was not so much of a continuation. And today, we had the gap up at the opening, but instead of the little continuation and overall positive day that we have in the broad markets, here
Went down.
what happened? Yeah, went down, and below the close of yesterday. So really, all of these, in my opinion, is screaming that something is going to happen next week on the downside, and is all. I mean, it's natural. It's not obvious, but it is natural. I'm not going to be shocked if this gap here are going to be filled, and as long as we stay away from this what is going to worry me is continue higher and higher, because then at some point is going to eat very, very badly. Okay, so the VIX, of course, is reflecting all of these because the market is going up, volatility is going down. Now, again, and that is confirming what I just said, volatility is going so down that at some point you can see how it's moving volatility. Uh, at some point, even if goes even lower, it may pick up again. And usually volatility pick up again when the market is put back. So After looking at the broad picture of the market, let's go to our options. This is my portfolio inside the option trading club. The main strategies that I trade over there on cash secure puts. And you know, we had today is the third Friday of the month, so is month expiration. So everybody's very busy because, if you like or not, the monthly expiration has more liquidity than the weekly, so we all tend to concentrate our trades on the monthlies. Anyway, I had several positions expiring. Let's start in alphabetical order. BWA, that actually has been quite a long trade. 109 days. I had to adjust these 3 times. And but at the end of the day, that's the beauty of being on the selling side of option. That has not been a great trade, because you see what happened. I got in on the 28th of June and thinking that this support was going to work, and it didn't. And look how bad this thing went. And I was lucky enough that at expiration, it went back up above my strike. So in the meanwhile, I had to roll 3 times. And what I did today, I was tempted to try and let expire worthless, but then I saw this very solid and long red candle. So I bought back before the close, just for 10 cents per contract. And at the end of the day, despite the trade went against me, I had to adjust 3 times. I end up with $285 per contract and a 20% annualized return in 109 days. That is almost 4 months. Now I want to make clear what this number is, this 20% annualized return, because it may be a little confusing if you are not in option trading and the way I record my trade. So as I said, this trade was open on the 28th of June, and I closed today, so 109 days. So total, I got net, this is not including commission, but this is basically the premium I collected when I opened the position and during the 3 adjustment, minus what I paid today to buy back the put. So total net, I got 285. If you divide this by the capital that I had to allocate to secure this position, that of course a contract is 100 shares, so it is 47.5 times 100. So this is the total I have to per each contract to allocate, and that's come to a 6% return on investment. Okay, but then we have to consider the duration of the trade in a way. So if you do 6%, you divide for the number of days, that's come to a profit average of 0.055 per day. Okay, so on average, this trade produce this percentage per day. So if you do this times 365, so 1 year, you get to the 20% return. So basically, this is like saying, if I close this today, if I open another position like this and a Monday and keep going for another year in this condition, at the end of the year, I will get to a 20% return on my capital that I put at risk. And that, I think, is very useful because it allows to compare a trade to another. So basically, these allow considering the premium you were able to collect and the duration of the trade. You can compare apple with apple, really. on each single trade, because otherwise it may become confusing. So these tell you in a year, if you keep your capital at work, how much you can expect to have based on this trade. Make sense?
Makes a lot of sense. Another way that I kind of do it, and it's the same math, but you know, I tell myself the 109 days that this trade was in, how many of those trades I could do the same way in 1 year. So I do 365 divided by 109. That comes up to a point or 3 point something,
Yeah.
and then times 285 divided by 4750, which would give me the 20% ROI. So that, in other words, just to make it simple, that means that if that trade would have lasted 1 year, you would have gotten 20% on your overall for the year.
Correct. Or on another simple way to understand, it's, let's say you do a trade for a month, exactly 1 month, expiration to expiration, and that produce 2%, then you can expect 2% times 12, 24.
If you would do the same trade 2% every month, that would give you
exactly. That's the whole point. But I think this is a key, for me at least, is a key number to compare a trade to another, because sometimes that is two ways. Sometimes when this is too high, it tells me that the trade is too risky. So for example, if I get, because I do this math before entering into the trade, if that number comes to 200% annualized return, there is something that is not right. Or on the opposite side of the spectrum, if it comes to be 10%, say, maybe I'm too risk adverse, and maybe the underlying instruments is too conservative, or maybe my delta is too small. Again, and that means that is probably it doesn't even worth the to bother with that trade, because you are putting capital risk for an analyzed return that is too low. So again, doing this over and over again give you a sense of what's going on in the trade. So for me, is very, very useful.
What do you like to see when you build your trades? Is it 20, 30%? What around what?
I would say I'm not happy with anything below 15. And I usually don't get anything above. Again, depends on the duration. Sometimes I have very short duration trade that can have even 100%.
Yeah, those are
but
higher.
On a normal duration, that let's say a cycle, 30 days or 45 days, I rarely go over 30, 40. So long story made short, I think the 30% is probably the sweet spot for me.
That's my opinion. A 45-day deal, 30% AROI. Yeah. I'm comfortable with that. I mean, it depends on who's comfortable with the risk and all that stuff, but I'm comfortable with that as well.
Yeah, let's say it's a good target. It's definitely a good target for me as well.
And one last comment, sorry, Gianmarco, on this trade. I know I said that in the previous episode that we've done, but it's, you know, to me, the beauty of options is you went into a trade, you saw the resistance, the technical analysis. It didn't work out, and these things sometimes happen. But you were patient, and you were still able today to get out of that trade, even if that trade went down against you, and now it came back up, and you still made a 20% ROI. That's to me, that's the beauty of options. How
yeah, absolutely. That's make all the difference in the world to me, and is the difference between being a stock trader or a buyer of option, that is even worse, against being a seller of premium. Because let's be honest, I did all my due diligence here, but nobody knows what is going to happen. Nobody, really. I have no crystal ball, nobody else. Arrive here, I do my forecast, and it's not going to happen. If you are a stock trader and you enter here, up here, at 47 something, and then you go down here, I mean, let's look at this consolidation and then a gap down. What do you do here? You panic, you sell. Because, oh my God, my stock is becoming garbage. And you panic and you sell. That's normal for a stock trader. But if you're a premium seller, as you said, you are patient, you stick to your plan and wait and keep rolling and adjusting. And it's not just about rolling, you can roll down, you can double down, you can even get a sign at some point, but in a way or another, you can get out of these with a profit like I did, or at least with a minimal loss, not buying here and selling here, not buying high and selling low. That is what happens if you are just a stock trader that you panic. So again, I'm totally agree 100% with you that is the beauty of these kind of strategies with options. Absolutely.
That's great. Let's continue.
Yeah, let's go down because, as I said, I had quite a few positions this week. This is down. This is no rolling. Again, that is a normal trade for me. 23 analyzed return in 29 days, no adjustment. So maintenance free. I didn't do anything with this, expire worthless. And then I have KBH, same, this is a shorter duration. And you see sometimes when this shorter duration is a little more speculative, the ROI tend to be higher. And sometimes you start with these and then you have to roll. So this number here start to go down, 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 down. So this is why sometimes I like to start on the higher side, because if I know that if I need adjustment, I can go down and still a very, very decent profit. And then we have Leonard as well, very easy trade. Actually, I remember I entered with this very close to the strike. It was a level of support. And again, 32% in 32 days, that's is bread and butter. And here I had to do an adjustment, but again, you see, you are in this position, you don't panic, keep adjusting, and you end up here, nice return in 46 days. And sometimes when you roll, what's happened is that you have to tie your capital longer, but that is good because you got this kind of analyzed return for a long time period. That is your money is at work, so it's all good.
Can't go wrong with that.
And this is two adjustments, so longer trade, 79 days, 29% analyzed return. You can see the amount of money you can generate. This is what I cash back today, because now I'm risk-free on this position, I'm out, and I take this money and reinvest. I mean, that's really good. And here an adjustment, again, excellent analyzed return despite the adjustment. You see, again, you do your due diligence and then this happened. Look how down it went, but you can be patient because you have the tools to protect yourself. You can allow yourself to be patient, and then it went up again as a V shape. I mean, really, honestly, when I was a stock trader, I've been a stock trader for a long time, it's difficult to resist in here, to the temptation to get rid of the position. And sometimes it is even good practice because you can protect yourself with stop losses and this sort of protection, but it's so much better, the tools that you have at your disposal as an option seller. And then these again spike up yesterday, so no problem at all.
Good one.
No rolling, no adjustment, and very high analyzed return. And that is the last one I got for today. That's interesting, very interesting. This is 135 days. Is a stock that I really like. I sold puts even before last year as well. I really like this company. And at the end of the day, after 4 adjustments, 34% analyzed return. And look what happened today. Again, that is the panic mode because it was a very easy trade up to Wednesday. Then the market went up, and this was destroyed. Look at this candle yesterday. And today I had two possibilities. Wait until the end, and if I wait, actually two possibilities. Wait until the end and try to let expire worthless, and in that case I was going to be assigned for 1 cent. Not a disaster, because I could have sell the share on Monday, or keep rolling. But to be honest, I've been ready for a lot of time in this trade, so I really wanted to get my to free up this capital and look for other possibility. So I decided to buy back the puts
But the
on the lot.
cheap, right? You didn't
Yeah,
spend.
it was pretty cheap. I, instead of banking $900, I paid $24 per contract to buy back the position, and it's fine. The risk is off, and avoiding any mess at the end of the week. Okay, so that was a very busy week, because these are the positions I was able to close. I had other positions that I rolled during the week, and that will come to further expiration. But I had, I think, 20 positions open this week to manage. So it was a very busy week. And what for next week? To be honest, in this market environment, need to be a little careful before opening new position. I always like to do a little by little, not to go all in one single day, but do a few, one position, two position per day, or none, if the conditions are not right. And usually in the monthly expiration week, I am very focused on adjusting what I have rather than opening new position. Also, because if you consider, when you roll a position, in effect, you are like opening a new position, because you are going to a further expiration. But anyway, I did open some new position. One of these that I did today is K-Web. And again, I want to show you the calculation analyze return, because I do this not at the end of the trade, of the campaign, but I do before. So I opened this today. This is not a significant level of support, I have to say, but I like this choppy consolidation. I like the delta, the IV, the fact that this overall, this is a very beaten sector ETF, so is in a sort of consolidation pattern, very low. Consider that thing arrived to 105, so is almost 50% from all-time high. So I'm pretty comfortable to trade this level. And so my analysis is the money I got paid per contract. I can work out, if these expire worthless in 2 weeks, I will get a 40% annualized return. And the calculation is the same. But again, here you got a 1.54 return on investment. But again, it's a shorter duration against the, here you that could be misleading, because here you have a 6% return investment, but it's over 109 days. So here you have a shorter duration, sorry, here K-Web, shorter duration, and the lower return on investment. So if you analyze this, divide by 14 days, you get 0.11, and times 365, you get to the 40 analyzed return. This is why you can compare a trade Apple with Apple doing this way. And then this maybe is not going to last 14 days, it's going to last 100 days, and maybe this is changing, it's going down, because I need to adjust. But at any time, I have the sense of what's going on in the position. Okay, so really, I don't think today is a great day to select any picks for next week, because I want to see what is going to happen Monday and Tuesday, and then reassess the overall situation.
Yeah, let's be careful for next week as well. I agree with that, and might be looking at closing some positions on Monday or Tuesday to make sure that I get that capital back and reinvest if ever we have another big down day or big down week next week. So we'll see. Maybe we're wrong. We never know. But let's see what it brings.
We need to be ready for everything.
Exactly. All right. Well, thank you very much for all of this presentation. Just to remind the members and our subscribers, if you guys want to take a look or be part of all the discords of the option trading club that Gianmarco manages, all these stocks, all these positions, all these options are shown there. It's really well organized, so I recommend that you take a look at it. The link is below in the description, and you are also welcome to join my Facebook group at Option Wheel Strategy. Everything is below in the description, and I definitely recommend that you sign up for Gianmarco's newsletter. It's free, and you'll get a lot of great information as well. Gianmarco, as always, thank you very much.
Thanks to you, Sam.
And we'll talk next week.
You too.
Thank you. Bye-bye.